Okay, let's dive into this. Welcome to today's Explainer, where we're tackling the absolute biggest and honestly the most heavily debated initial public offering in the history of the stock market. Yep, we're talking about the June 2026 SpaceX IPO. We're going to look way past the shiny rockets and the crazy headlines and drill right down into the actual financial engineering and the source data that drove this monumental event. Here's our agenda for today. We're going to start with the trillion-dollar IPO, then look at Starlink as the profit engine, and explore XAI and orbital computing. After that, we'll cover manufactured market scarcity, the Mars transfer deadline, and finally wrap up with the insider lockup risk. All right, Section 1, the trillion-dollar IPO. So here's the big question, right? It's really the central question for this entire explainer. How on earth does a rocket company, a business that's historically been plagued by massive capital costs, blown up prototypes, and just, highly cyclical government contracts, how does that become worth $1.77 trillion? There's this massive disconnect between the public's perception of physical rockets blasting off launch pads and the underlying financial math that Wall Street is actually using. $1.77 trillion. Just let that sink in for a second. To put that into perspective, at $135 a share, this valuation instantly positions SpaceX as the sixth most valuable U.S.-listed firm on its very first day of trading. It also officially made its founder Elon Musk the world's very first trillionaire. But a valuation this stratospheric means investors are definitely not paying for what the company is doing today. They're paying for a flawless, absolutely perfect execution of what the company claims it will be decades from now. So what's actually paying the bills right now?
Let's get into Section 2, Starlink, the profit engine.
And this brilliantly illustrates the internal financial architecture of SpaceX. When you break down the 2026 revenue forecasts, the launch segment, which, is what SpaceX is famous for, is basically capping out near $5 billion. Why? Well, because there are hard physical limits on how fast you can turn around a launch pad. But then look at Starlink. Driven by 12 million subscribers as of June 2026, Starlink is projecting $15 to $20 billion. And here is the kicker. 85% of that is recurring subscription cash flow with a massive 63% EBITDA margin. Starlink is literally the definitive profit center that's subsidizing the rest of the entire company. This shift changes absolutely everything about how the company is valued. If you value SpaceX as a traditional aerospace manufacturer, kind of like Boeing, you're looking at the metal, the hardware, and the factories. But the market isn't doing that at all. Wall Street is treating SpaceX like a subscription software as a service, or SaaS, utility. That's exactly why underwriters priced it at an incredibly aggressive 73 times forward price to sales multiple. Just for some context here, established tech monopolies like Meta traded around 16 times sales, and Alphabet sits near 25 times. Investors are paying this massive premium because they think they're looking at a future global telecommunications monopoly. But honestly, even a telecom monopoly doesn't quite justify nearly $2 trillion. Which brings us to Section 3, XAI and orbital computing. To bridge that massive trillion-dollar gap, we have to look at the futuristic orbital computing narrative. Independent analysts have fiercely debated the underwriters' claims here. In their prospectus, SpaceX cited a total addressable market of $28.5 trillion. That is literally the largest in human history. Crucially, 90% of that was attributed to artificial intelligence through their recently acquired XAI subsidiary. Now, skeptics, like the famous hedge fund manager Michael Burry, pointedly noted that the actual financial filings just do not support these astronomical numbers. They argue that the valuation is completely disconnected from present reality. When we look at the raw data, XAI is currently a massive cash burner. Sure, the Grok and X platforms bring in about $3.2 billion in revenue, but the infrastructure to actually fight the AI war, specifically the 1 million GPU Colossus supercomputer project, requires a staggering $14 billion cash burn rate. That's huge. To validate this, SpaceX did secure massive cloud computing contracts with Anthropic and Google, generating billions in monthly run rate right before the IPO. But the really crucial takeaway here is that right now, those highly profitable Starlink subscriptions are actively draining out to subsidize a hugely expensive AI development war down here on Earth, all built on the promise of moving data centers into orbit at some point in the future. Okay, Section 4, manufactured market scarcity. Now let's step away from the business model for a second and look at the actual Wall Street mechanics that engineered this specific $135 IPO price. Market analysts have called this one of the greatest degrees of manufactured scarcity ever seen in an IPO. Here's how they did it, step by step. First, SpaceX only offered a tiny 5% float to the public. For comparison, companies like Apple have over 90% of their shares in circulation. Second, they leveraged their immense size to force a Nasdaq rule change, allowing the stock to enter the major Nasdaq 100 index just 15 days after the IPO, rather than waiting months like everyone else. Finally, this early index inclusion forces broad index funds, the very funds sitting in your 401k, to automatically buy the stock at exactly the moment supply is most constrained. It artificially pumps up the price.
Moving right along to Section 5, the Mars transfer deadline. Let's move to and see how this builds out in the physical world. While Wall Street is busy manipulating supply and demand, SpaceX still has to contend with the uncompromising laws of physics. Looking at the timeline, we can see how physics dictates a very rigid operational schedule. Earth and Mars only align for fuel-efficient space travel once every 26 months. This creates an unbelievably unforgiving schedule. For the late 2026 window, SpaceX is planning 5 uncrewed Starship landing tests to prove out critical things like orbital refueling and reusable heat shields. If they miss this window or if the tests fail, the entire timeline, including the first crewed flight in 2028, gets pushed back a full 2 years. For investors who price the stock based on flawless execution, a 2-year delay could be a devastating blow to the company's valuation.
And finally, Section 6, the insider lockup risk. If you're buying this stock on the secondary market, this is absolutely the most critical mechanic you need to understand. A lockup period is standard practice in IPOs to prevent early investors from immediately dumping their shares and just crashing the stock price on day one. For SpaceX, early venture capitalists and employees have a staggered 180-day lockup. Elon Musk and the core insiders, they're locked in for 366 days. But keep in mind, these early investors hold shares that they acquired at a tiny, tiny fraction of that $135 listing cost. When these windows expire, that artificial scarcity we talked about earlier completely ends, and millions of new shares are going to suddenly flood the market. Also, notice the massive disparity in the voting power distribution. Despite selling shares to the public, this is for sure not a democratized company. Through a dual-class share structure where Class B insider shares hold 10 times the voting power, Elon Musk retains an absolute 82% grip on voting control. So public shareholders are essentially just along for the ride. They're funding these incredibly capital-intensive AI and Mars ambitions without having any real say whatsoever in the boardroom. So what does this all mean? We've seen how SpaceX is using Starlink profits to fund a brutal AI war, and exactly how Wall Street engineered a low-float debut that forced regular index funds to buy at a premium. The ultimate question you have to ask yourself as we look ahead is this. When those 180-day and 366-day lockup periods expire and the early insiders finally cash out their massive, massive gains, will the retail investors and retirement funds be the ones left holding the bag? It's a fascinating study in market mechanics and a really good reminder to always look past the hype and check the hard data. Thanks so much for joining me on this explainer. And remember, keep questioning the numbers.